Good morning, you magnificent melon heads. Happy Inflation Day, everybody. We are just 15 minutes away from the December Consumer Price Index, or CPI, courtesy of the Bureau of Labor Statistics. It is that wonderful day when we find out at what rate is our money becoming worthless. Isn't that nice? Let's see. Right now, market is expecting 6.5% headline year over year inflation. That would be down. What happened there? That would be down from our previous level of 7.1% that we saw back in November. Market is also expecting a negative 0.1% month over month number. That would be the first negative month over month number a year and a half, maybe in a long time. The culprit there is energy, which would be driving the headline year over year. I'm sorry, the headline month over month number a little bit lower. We had a big drop in gasoline prices in December, big drop in oil prices, energy lower. The cold winter never really arrived, not until the tail end of the month. And so we're looking at the possibility of a negative month over month number, believe it or not, driven primarily by energy, even though core inflation is still expected to be 0.3% positive for the month. And they're also looking at 5.7% core inflation headline. So that was a lot of number salad there. But that is what the market is expecting right now. We've had a lot of optimism built up in the stocks recently and asset prices. Things have been trending in the upward direction. It seems like everybody is expecting this significantly lower inflation read, and that's causing a lot of optimism. Maybe the Fed is going to ease off on the brakes. Maybe they're going to let us breathe a little bit, although the Fed has come out and said explicitly over and over again that they're not going to do that. The bond market doesn't believe them. The bond market is saying the Fed is about to pivot at some point this year. All right. With that, let's go over and let's take a look at what is going on in markets this morning. We are also going to say hi to Mish, who is in an area right now where there's not very good signal. We're spotty at best right now, so Mish might be a little quiet today, but he is out there. Everybody say hi to Mish in the comments. He just dropped off. I think I think his signal was really hitting. All right, so let's take a look at what's going on in the markets right now. Looks like the S&P 500 is up about 12 points ahead of the open, or about a third of 1%. The Dow currently up 100 points pre-market, also about a third of 1%. And the NASDAQ up a little bit less, 23 points, or 0.2%. So stocks are looking a little optimistic again this morning, and that's after a really good run that we've had the first few days this week. The U.S. dollar index right now breaking down below that 103 level. We're back into the 102s right now at 102.97. We were very briefly in the 102 handle area. I think it was on Monday. The DXY is down from its all-time high of around, not an all-time high, but its recent high of about 1.15. So significant reduction in strength of the U.S. dollar. Again, that is the dollar measured against other global currencies. And in the bond market right now, looks like we have got the short end of the curve is up just a tick, with the 1 month and the 3 month up just a fraction of 1 point. And then the long end of the curve, we've got yields down. So the short end of the curve yields going higher, the long end of the curve heading lower. That is even deeper inversion in the yield curve right now. So that is more risk piling up in markets, with the 10-year right now at 3.51, down about 4 basis points. Let's also take a look at commodities right now. Looks like we got mostly green today. Gold is up $13 at $18.92, still flirting with that 1900 level. Will we see that today? Who knows? We'll see after the CPI comes out. Silver back below $24 at $23.91, but up 43 cents this morning, or 1.84%. Copper's had a pretty good run recently at $4.17. Let's see. Platinum is back below 1100 at 1080, down $3 this morning. And WTI crude is quietly ticking up. Had a couple of good days in a row now. 78.52, up $1.10 this morning, or 1.41%. Flirting with the 50-day moving average on WTI crude futures. So that is also something we'll be keeping an eye on. All right, what we're looking at right now, this is BLS.gov/CPI. This is where the Consumer Price Index will be reported in just under 10 minutes now. And right down here in the lower right-hand side where it says CPI for all items, that's where we'll see the headline come in. So we'll be refreshing that like a madman when the time comes. But before we get to that, I have got to say good morning and thank you, sir, to Mr. Mike Bender from Robin RC Models. Thank you, Mike. He says good morning. Did you see the South Korean shift to nuclear power? I did, and thank you for sending that to me this morning, Mike. Mike is always out there scouting the headlines and sending me stuff, feeding me information that keeps the content flowing on the channel. Thank you for that. Long overdue, I think. They they reduced their targets for renewable energy. It's still, I think they reduced it from like 30% to 21%. I may have the numbers off a little bit. They're still expanding their renewable energy targets, but they're expanding their nuclear targets by more. And I think that is a wise decision. If there's one thing we saw, especially over the Christmas holidays, is that we need reliable baseload energy, and that's what nuclear provides. So I think South Korea is making the right call there. And thank you very much, Mike, for the support of the channel and for everything you do, your research and your DD. And I've also got my friend EC660. Thank you, EC, for the super chat. He says, hey, Jack, what was the inflation number for January of last year? Oh, the January number last year, that's going to be, let's see, can I get to that one quick? Here, let's bring this up. St. Louis Fred. Let's see if we can find January last year. We're searching this. CPIU. No, that's not the year over year change. Well, EC, I can't get to that number right now off the top of my head, but let me just say this since you're bringing up January. I think the base effect is going to start playing a serious role here. And the base effect is in statistics when anything is being measured as a rate of change, which CPI is. They measure the CPI versus year over year, comparing this January to last January, or the number we're about to get December 2022 to December 21, the year over year change. If you had a year ago a big step change up or a big step change down, when that number ticks off the following month, you can get a big change caused by the base effect because the number you're comparing to jumps one way or another. It's going to make the current rate of change look much more severe. And right now, what we're heading into, it was early last year is when CPI really started to gain steam. It's when we went from 3-4% all the way up to, in June, we hit 9.1%. So the reason I say that is because these numbers that were big increases are going to start slowly ticking off over the next 6 months or so. It's going to have the base effect. It's going to serve to bring these CPI numbers down. That doesn't mean life is not getting more expensive. It just means the rate of change is coming down. It is disinflationary. Prices are still going up. They're just going up slower. Any number in positive territory for CPI is still inflation, right? And that base effect, that is going to play an important role. In particular, that is going to play a big role in used car prices, which is why I have this chart up here right now, the Manheim Used Vehicle Value Index. This chart is the best measure we have of like the average used car price in America. And the reason I'm talking about this one here, if you see back in January of 2022, that is when this meteoric rise in used car prices really started, all through January 21 and 22. Well, all the numbers last year, we were comparing the 2022 number to the 2021 number. Well, now we're comparing the 2023 number to the 2022 number. Big difference. Even though the price of used cars, it hasn't moved as much. They are coming down, and they're coming down fast. But compared to what they were doing last year, we're going to have a significantly negative month-over-month number in the used vehicle value index. And the year-over-year number is also going to be ticking way down. I mean, we had some year-over-year numbers like 45% last year, and now we're looking at negative numbers. So that's going to really weigh down the index. Food is going to continue to be a positive, and thank you, EC660, sir. I really appreciate the super chat and the support of the channel. Food is going to be a positive one. We've had continued inflation in food. We've all been following this drama in eggs. I had a lot of fun talking about the egg inflation the other day with my boy Squeaky the Rooster. Everybody seemed to really enjoy him. He's just a prima donna, though, folks. I'm sorry. He takes up all the airwaves. So food inflation, that's going to continue. Energy is going to be negative for the first time in a while. It's going to be negative on a month-over-month level. It may still be positive year-over-year. Again, you're comparing to the previous December. But this is going to be the lowest headline, core, and total number for quite a while. Now, the question is, what are markets going to do? There is a lot of optimism built up in markets, and you can even see it this morning with the S&P is already up 15 points, a little over 0.38% right now. So Lower than expected, market probably rallies on optimism of what the Fed is going to do. Higher than expected, the market likely sells off on that news. If it comes in right in line, I'm guessing the market's going to sell off a little bit because there's a lot of optimism built up. There's a lot of positivity priced in. And if they don't get that, well, the market's going to sell off. I also think it's not really that big a deal. Not to understate how important CPI is, but last year, I did a video about this last night. Last year's CPI was like the single most important number in markets. Everybody was following that. Inflation was the story last year. It's not anymore. The story this year is going to be the recession. And if you're talking about the recession, then we're talking about jobs and we're talking about wages. Those are the important statistics right now. Because if we get a big spike in layoffs, if we get fewer jobs, if people are suddenly out of work, then we're going to have a big supply of houses suddenly hit the market. And right now, the housing market is very illiquid. So that is going to cause a very rapid contraction in home prices. That's going to cause a lot of defaults. It's going to cause some homeowners to walk away from properties. We'll have the zombie homeowner phenomenon again, like we had in 2009, 2010. So it's important to pay attention to the CPI numbers right now, but I think everybody is hyper-focused on inflation, and really it's jobs and also wages that's very important because the average person right now, half of the people in America, half of the consumers already cannot afford life. And you can see that in the credit card numbers I was talking about last night. If people already can't afford life, then does it really matter if life goes up by 6% or 7%? If they already can't afford it, then what? They just can't afford it more. They still can't afford it. Now, the big question is if those people lose their jobs, not only can they not afford it, now they've got to sell their house. Now, they're defaulting on their credit card payments and everything. So I think that's the more important statistic right now. So I do think the market is maybe being a bit too optimistic about what this CPI could mean for everything. And another thing I also want to point out, we're going to watch this in the first minute or in the last minute right up until the release, is are they going to leak the information? Because this story was in Bloomberg yesterday. Traders lose trust in CPI data security in wake of volume shock. You may recall from a month ago, in the 1 minute prior to the release at about 8:29 a.m. Eastern time, we saw a huge spike in trading in 10-year treasuries. Somebody got wind of the information ahead of time, and that's not supposed to be allowed. That's not legal. Can't do that. You cannot trade on non-public information. And somebody did it a lot last month. Of course, the Bureau of Labor Statistics, they investigated themselves and found no wrongdoing. I'm shocked. Nobody, the SEC, the CFTC, nobody else looked into it. But we'll see if that happens this time around. And we're now 2 minutes away, just 2 minutes, so we'll see what goes on. Real quick, I want to get to my friend Tim Duffy. Thank you, Tim, for the super chat and support of the channel. He says, sorry for jumping ahead, but what do you think of bank earnings tomorrow? Banks are going to see a big spike in net interest income because interest rates are higher. Banks make more money when interest rates are higher. We're probably going to see a big decline in some of the revenue from things like IPOs and SPACs. That's going to hurt them. But the big question is going to be loan loss provisions. How much money do the banks set aside? And when they set that money aside, they take big hits to their earnings. How much money would they be setting aside for loan loss provisions? And I think we're going to see some big negative earnings numbers starting tomorrow because of those loan loss provisions. Now, how big and bigger than the market is expecting, I don't know. But that's going to be a good indicator about how bad the recession could be, is if you see the banks setting aside billions of dollars for loan loss provisions. Thank you, Tim Duffy, and that was an excellent question, sir. And we are now inside of 1 minute. Let's see, is anybody trading this? Uh-oh, big green candle up. Look at it go. There it is in the Dow. There it is in the S&P. Oh, boy, is the Dixie. Uh-oh, big red candles down. Did somebody learn something we didn't learn? Uh-oh, that's not good. Let's see what the U.S. 10-year. The 10-year is down 5 bips right now, or 1.46%. Not as big as we saw last month, but we do see people moving already. All right, it is now 8:29. We're just a minute away. Again, we are expecting 6.5% headline year over year and negative 0.1% month over month. See if it comes in anywhere near that. That's down from the 7.1 and 0.3. Still showing the November numbers. I got 8:30 where I am right now. We're going to refresh this just a few times until we get the December number appearing. Looks like, I see some big candles forming. Come on. Everybody knows something that I don't. What is going on in the world, folks? Still showing November. Still showing November. They're usually very reliable here. I'm going to take a sip of my wake up juice while I hit refresh like a madman. Still showing November. I've got somebody. All right, everybody's giving me their guesses right now. Hey, Brian Zarb is there in the chat. Hello, Brian Zarb from thetechnicalchartist.com. Come on, guys. We're like 30 seconds into it right now. Still no December showing. There we go. CPI falls 0.1% for December, exactly as predicted, and 6.5% year over year. All right, so we are precisely in line. Here we go. Reading from the CPI for December, the consumer price index for all urban consumers declined 0.1% in December on a seasonally adjusted basis. There's the asterisk. After increasing 0.1% in November, the U.S. BLS reported today over the last 12 months that all items index increased 6.5% before seasonal adjustment. The index for gasoline was by far the largest contributor to the monthly all items decrease, more than offsetting increases in shelter indexes. The food index increased 0.3% over the month, with food at home rising 0.2%. The energy index decreased 4.5% over the month as gasoline index declined. Other major energy component indexes increased over the month. All right, let's take a look at the numbers here. What we're looking at in the chart. Zoom in just a little bit. All right, for all items, here is your headline number, 6.5%. That is your all items year-over-year number. There is your negative 0.1% for the month-over-month all items. Food at home up 10.4% year-over-year, 0.3% month-over-month. That continues to hit Americans in their wallet. Here's the big one right here, energy, negative 4.5% for the energy index. We had some positive 30, 35% numbers about 6 months ago. So that's a big reduction in energy prices. Still 7.3% in positive territory for the year-over-year number. That's going to continue coming down unless we get a big spike in energy prices, which could happen. It is going to get cold in Europe eventually, folks. Let's see. Gasoline minus 9.4% for the month. Okay, here we go. All items less food and energy. That was your core inflation number. Again, right in line, 5.7% year over year and 0.3% month over month. Let's see a couple of the other ones. The index for shelter, 0.8% month over month and 7.5% year over year. So that's interesting because I don't know if you guys caught the interview that I did with the Happy Hawaiian a couple of weeks ago. Look for the thumbnail. It was a 3-part interview called Garbage In, Garbage Out, where we talked about some of the flawed data that the Fed and that the economy is using right now to determine the state of inflation. And one of those was talking about the shelter index. And the Happy Hawaiian pointed out that even though the shelter index, in particular owner's equivalent rent, continues to rise, the actual rent on the ground, he went and he looked at like Zillow and Redfin and their indexes. The rent has actually been coming down for the last 3 months, even though the shelter index in the inflation report is continuing to go up. Now, the reason for that is because the shelter index and the inflation numbers are so ridiculously understated, and they totally ignored this drastic increase in rent prices over the last 2 years. So it's still playing catch up, even though the rent has already peaked and it's already starting to tick down just a little bit. According to the inflation number, it's still going up. So the data is once again being skewed, and shelter is the culprit. So here we go again. The shelter index has gone from 0.6% in November to 0.8% in December. Still on the rise, still rising faster, even though those prices are coming down. That number should have been much higher in the past, and it should be negative now. Let's see. Also, we got a little bit of positivity in transportation and medical care. A big number for transportation services, although that doesn't hit the index quite as hard. So let's see what markets are reacting. And folks, I just want to caution you, the market's reaction is not always the right one. These are algorithms driving the trade right now. We've seen big moves only to watch them reverse in an instant. So I don't like to trade around CPI reports, but let's see what we got right now. We did have a big drop, and now we're ticking right back up. The S&P is up 6-7 points right now. Again, same thing with the Dow. Big candle down, and now it's buying it back up. Currently up 47 and rising. NASDAQ had the same thing. Big candle down, down -10 right now, but also rising. The dollar index, we've got still 102.97. So the Dixie didn't react too much to what was going on there. The bond market, we've got the short end of the curve is heading higher right now. That is, the yield's heading higher, so the prices of those bonds are heading lower. The long end is still negative, so we've got a deeper inversion in the yield curve right now. I mean, look at this. We got 3.5 on the 10-year and almost 4.9 on the 6-month. I mean, 140 basis points inversion from the 6-month to the 10-year Treasury. That's amazing. By the way, shout out to Keenan Haywood from my Patreon group who pointed that one out to me yesterday in an email. Link down below to the Patreon should you feel so inclined. Let's see what is going on in commodities. We've got gold has finally retaken the 1900 level. Look at that big, beautiful green candle up in gold, currently at 1901.75. All right, that was a psychological resistance level that we've been hitting. We'll see if it stays there. And what do we got going on in silver? Silver is at back over 24, up 65 cents on the day now, or 2.67%. All right, so in line with expectations, markets reacting, but not overreacting, I wouldn't say. I would expect the market to tick down, to be honest. If there was so much positivity built into the markets, and then the inflation numbers came in exactly where they said they would. So I would expect a little bit of a sell-off right now, to be honest with you. Again, right now, this is just the algorithms are wrestling with each other, so we're not going to look too much into that. Let's get to the chats here. I had my man Brian Zarb just came in a second ago. There he is. Hey, Brian, thank you for the super chat, sir. Support of the channel. USD jobless claims, actually 205,000 for 215,000, previous 206. Did that just hit the tape also, the jobless claims? All right, so the forecast was 215, the actual was 205. Is that initial jobless claims, Brian? That's one we're going to keep an eye on. The jobs data, the big shock, I think, in the jobs data is going to come in February, because February is when they do their revisions to last year's number. And I don't know if you guys saw that Philly Fed article. It was about a month ago it came out, where the Philadelphia Federal Reserve Bank says that the Bureau of Labor Statistics had overstated jobs for just the second quarter of 2022 by 1.1 million. Now, they had said that it was 1,111,500 jobs created, when it was really only 10,500. Huge, huge discrepancy between the Philly Fed and the Bureau of Labor Statistics for the jobs numbers. So if all of that hits at once, if we see the BLS or the Census Bureau or whoever's going to come out with these revisions in February with a big revision down in the jobs numbers, first of all, it's going to make certain politicians look really stupid. And second of all, it's going to be a shock to the market, and it could cause something of a panic about the severity of the recession. So we'll see what happens with that. Thank you, Brian, for that data point and for the support of the channel, sir. I appreciate that very much. Once again, folks, if you're just joining us and you're late to the game, CPI was 6.5% year over year, negative 0.1% month over month. That is the first negative reading in quite some time. All right, guys, I think we are going to wrap it up and call it there. We are not going to be doing the 9:30 live stream that we've been doing for the last couple of days, because we've already got a live up for today. But we will keep an eye on whatever happens in reaction to this from this market. I want to say thank you to Mom and Dad. I love you guys. Thank you to my Patreon supporters and to my Blue Wrenches for keeping things neat and tidy in the chat. And until next time, live small and dream big.